Subramaniam Sahab here lends me 80 rupees. I invest 100 in the market. I've got into a leverage position. That's exactly the reason why the markets collapse. We're going to see this in this session. We're going to understand, and it's going to be kept very simple. Before I continue here, mark my words. The next bubble, we saw subprime last time. We are discussing stock markets. The next bubble will be in commodities. The next bubble is in commodities. So please try and understand finance. Let's not look at only NPV, IRR. Look at what's happening in the commodities. Post tea, right, your break, we'll discuss what's happening in commodities. The next bubble is already moved on to commodities. Look at the prices. Oil, right, I need not tell you all, right, gold, corn prices, 12-year high, 12-year high, cotton, pulses, name it. Yeah, there is a problem, there is a demand-supply gap, but there is an element of speculation. But before I get there and discuss, right, because I want to relieve certain colleagues after the tea break, I'll get there and discuss. Let me explain, because some of you have been wondering what's happening in the markets, why did this happen? Suddenly the markets tanked by 1,000 points. You would not have realized also. You would have called up your broker or you would have logged on. Suddenly you find the markets down. ICICI has reported massive losses. Chanda Kochar was called to explain why the losses. State Bank of India, right, is now revealing subprime. What's really happening? What's this credit derivatives? What's leverage? It's all linked here. I'm starting this session by making it very simple across by saying I have 20 rupees. I go to Alamgir Sahab. He says, Menon, take a position in the market for 100 rupees. Leverage. By having 20 rupees, I have gone into the market for 100 rupees. Now, what really happens is, there is something very dreaded that is known as mark to market. Now let's understand what's this entire position. Let's understand this case by taking a very extreme case. I have one rupee, $1, 1 dirham. Somebody gives me 99, I take a position on 100. The asset value moves to 101. Understand this very simply here. I have $1, 1 dirham, 1 rupee. I go into the market. Somebody lends to me 99. I take a position of 100. Why do I do it? You understand this here. Moment the asset goes to 101, I sell it. What's my return? Absolutely. The return is 100%. This is what is attracting most of these speculators. Why? Understand this. It's very simple. You got in at, your investment was 1. 99 was what you borrowed, or what the broker let you take a position on. You get into a position of 100, 10 people like you come in, the value moves up, you sell. You made your profit of $1 or 1 unit, whatever. Excuse me, your investment was 1. Your return percentage is 100%. Very attractive. People feel very good. Young boys, half your age, possibly the seniors here, sitting across, believe me, this is exactly what they were doing. As if there's no tomorrow, the index is only going to keep moving up. Absolutely. Name the stocks. Okay. There was RNRL. Company in existence with no projects, but people were talking about it going up to 500, 600. RPL, right, I'm sure some of you all from here would have put in your hard-earned money. Reliance Power, right, it's craze, absolute craze. Anybody there? No, believe me, even I was about to fall for it, but I said, let's wait and see. Please understand what happens in Reliance Power to open an, to open a demat account. I don't have a demat account. Sir, can I use your demat account? He says, yes, I'm ready to pay him 5,000 rupees. Only to actually go across and use his demat account. Craze, etc. Why? The logic is right here. Let it list, I sell, I make my profit. The problem with these things is, what if this asset rebounds back? Let us say it rebounded back to, let's say, 90. Stock markets need not go only one way. It can go the other way around. Moment it goes the other way, I'm dead. My investment is gone. I owe people money. The scene, sorry, the scene is pretty bad. People have pledged their houses. So yeah, this is exactly where I wanted to come back. Even last time, I wanted to keep you all abreast of what's this. People pledged their houses across the line, took loans, pushed into the markets, took positions 10 times, 15 times the money that they put in the markets. Markets moved backwards. This $1 is gone. Now I owed Mr. Alamgir $9 because he's funded me that part. What do? He will now sell my collateral. And that's explaining what is leverage, what really happened. Moment the index, let's understand this case, sir. Leverage is a deadly weapon. Hi. Leverage is a deadly weapon. It starts moving up very fast, but moment it rebounds, it takes you down even faster. What happened? Index went to 21,000. And the theory that was going across in the markets, very, very important theory that was going across in the markets, was India is decoupled. There's nothing to worry. US is in trouble, subprime, nothing to worry. India is decoupled. That was a very famous word, that was the theory that was going across. Decoupled. Decoupled meant nothing. We are not worried at all about the markets. India is away from US. 21,000, the first blip started. FII started withdrawing. The first FII that started withdrawing was the Citigroup. They started withdrawing. The second set of investors who started withdrawing was your Lehman Brothers, your Goldman Sachs. They started withdrawing. Now see what happens. Slowly the index moves from 21,000 to 20,000. Not much, it's just a correction. But then what followed was the drastic fall. What is the drastic fall? Let me explain this to you now. First thing is, people who had pumped their money into the market were all going through leverage. Why? I personally believe now that henceforth the markets are going to be very strong. Right? You will find this very surprising. Some of you are pretty scared. Aage kya aur girega kya? Right? It can fall by 1,000 points. It can fall up to 1,500 points. But the momentum is now upwards, not downwards. But here, the momentum clearly was downwards. I'll tell you why. Let me explain. What do you need to do next time? This is what you need to do next time. You should analyze the commodities now. Last time I came here, I predicted. I said there's a bubble in stock market, it will burst. Now I'm standing here and telling you all, there's a bubble in commodities market. It is waiting to be burst. When? I can't predict. Maybe 6 months, maybe 9 months, maybe a week from now. Commodities, mark my words. So those of you all who have got into mutual funds, which are investing in commodities, those who have got into commodities themselves, purchased gold, ETFs, you are just about, I think it's the right time for you to now move out of the entire thing. Why? The signals. Now let's look at the signals here. What happened was, people started getting into leverage positions. They started buying, they pushed it up. FIIs withdrew last interaction, and I'm sure you would remember about the subprime. FIIs started withdrawing, they were cutting losses. Now what happened is, now look what is happening next. Moment the loss starts, the broker starts doing something which is known as mark to market. But before I get there, right, a small noting on margin trading. Can I just give you a small noting on this to start off with? Leverage, a quick noting on the topic, especially for the colleagues who have come late, they'll get the context. Leverage is use of debt in financial markets. Investors can take a position on the markets by paying a small margin. By paying a small margin.